Okay, so let's dive into a paper that really solves a major economic puzzle, one that affects all of us. It's all about why inflation sometimes feels so incredibly sticky. And a fascinating paper by Timothy Cogley and Argia Sbordone offers a powerful and honestly a much simpler answer than what we had before. You've probably noticed this yourself, right? A central bank starts raising interest rates, they're trying to cool everything down, but prices, they just keep on rising for months, sometimes even years. It's this phenomenon that has had economists scratching their heads and has really frustrated policymakers for decades. Think about it like this. Imagine you walk into a hot room and you blast the AC. You crank that thermostat way down, but the room just stays stubbornly warm. For a long, long time, economists kind of thought the room itself, the economy, was just inherently slow to change. But what if the problem wasn't the room at all? To really get the breakthrough in this paper, we first have to wrap our heads around the puzzle it solves. And that is the mystery of what we call inflation persistence. So, what is inflation persistence? Well, it's pretty much what it sounds like. It's this tendency where if inflation is high today, it's probably going to be high tomorrow. If it's low, it's likely to stay low. It really acts like it has a memory of where it's been, and that memory has a huge influence on where it's going. And here's where things got really messy for economists. This whole idea created a huge conflict with the standard economic playbook. You see, a key theory called the new Keynesian Phillips curve says that businesses should be rational, they should be forward-looking. They should set their prices based on what they expect to happen in the future, not what just happened last month. So according to the models, inflation should snap to attention pretty quickly when policy changes. But in the real world, it just didn't. It often seemed completely stuck in the mud, just weighed down by its own past. So you've got this big hole in your main theory. What do you do? Well, for years, economists kind of patched it up with a workaround. But let's just say it was never all that convincing. The solution was basically to staple a backward-looking piece onto their forward-looking models. They just assumed that, okay, some chunk of businesses don't think about the future at all. They just automatically raise their prices based on whatever inflation was last quarter. This little trick is called indexation. And sure, it made the math work out, but it always felt like a bit of a cheat. And this fudge factor ran into some pretty big problems. For one, there was no good reason why firms would actually do this. But more importantly, it just didn't match the evidence. When researchers like Bills and Klenow actually looked at real-world price data, they found that tons of prices don't change for months at a time. They don't just get automatically bumped up every quarter. The old fix just couldn't stand up to the facts. And this is where our paper comes in. It basically throws that whole old fix in the trash and proposes something radically simpler and way more powerful. The authors asked a really simple but profound question. What if the memory wasn't a feature of inflation itself, but was actually coming from the policy that was supposed to be guiding it? What if all this persistence we see is just an echo of something else? And that something else is what economists call trend inflation. The easiest way to think about this is that it's the target temperature on the thermostat. It's the long-term inflation rate that the central bank is shooting for. It's supposed to be the anchor for the whole economy's expectations. Okay, now here is the absolute killer insight of the paper. For decades, economists just assumed this trend, this target, was a constant, but it wasn't. The central bank's long-run goal was actually a moving target, slowly drifting up and then slowly drifting back down over the years. And I mean, the data makes this crystal clear. The paper estimates that back in the early 60s, the trend was hovering around 2.3%. Then during the Great Inflation of the 1970s, it drifted all the way up to almost 5%. And by the early 2000s, it had fallen all the way back down below 2%. That is not a stable anchor. That's an anchor that's been dragging along the seafloor. And that right there is the aha moment. The stubbornness, the persistence that everyone was trying to explain with all these complicated fudge factors, it wasn't a feature of inflation at all. It was just reflecting the persistence of the central bank's own slowly shifting long-term goal. I mean, it's a beautifully elegant theory, right? But does it actually work? Does it fit the data any better than the old, clunky models? Well, this single number tells the whole story. Once you actually account for that drifting trend inflation, how much of that backward-looking fudge factor do you need to explain the data? The answer is zero. Absolutely none. It completely vanishes. The results are just stunning. Suddenly, a purely forward-looking model with no patches, no fudge factors, fits the data perfectly. The models estimate for how often businesses actually change their prices, about every 3.9 months, lines up almost exactly with those real-world studies we mentioned earlier. And get this, the model also shows that when trend inflation is higher, firms become even more forward-looking, not less. So, okay, why do we care? This is way more than just some dusty academic debate. Solving this puzzle has massive, real-world implications for how central banks should be thinking about their job. Let's go back to our hot room analogy one last time. It turns out the room wasn't being stubborn at all. The problem was that somebody was slowly turning the target on the thermostat up and then slowly turning it back down again. The economy wasn't ignoring the central bank, it was following its lead, even when that lead was, well, drifting. And this insight is a game changer. It moves the focus away from some inherent stickiness in the economy that we can't do anything about, and it puts the responsibility squarely on something policymakers can control: the stability and the credibility of their own long-term targets. The stubbornness isn't a given, it's a direct result of policy choices. This gives us a whole new playbook. If a central bank can credibly commit to a low and, this is the key, stable long-run target, it anchors everybody's expectations. The economy stops having this memory of past inflation and becomes much more responsive to what's happening today. And that means if inflation does flare up, bringing it back down could be a lot less painful, with a lot less economic damage than it's been in the past. So the ultimate takeaway here is that maybe the most powerful tool a central bank has isn't just raising or lowering interest rates, it's their own credibility. The beliefs that are held inside the central bank have this profound ability to shape the economic reality for all of us outside of it. And that forces us to ask a really important question. Just how solid are those beliefs today?